Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com.
Welcome back, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper, joined today by my guest, Louis Cammarosano, the general manager of HomeGain. Quick reminder, the show is dedicated to building and restoring the housing market in the Washington, D.C. metro area by giving you good free advice. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is 877-245-2030. That's 877-245-2030, or via the web at realestate360live.com. That's realestate360live.com. On the right-hand side, there's an Ask a Question button. Just click that, leave your email and your question, and I'd be glad to get back to you by the end of the day with any concerns that you may have. Like I said, whether it's regarding finding a mortgage, getting your credit fixed, short sale versus foreclosure, you're struggling to get a loan modification and want to know what to do, any of those questions, or if it's just a general question, and if I can't help you, I'd be glad to point you in the right direction of a professional that can. I want to jump into this week's Market Movers. This segment was brought to you by HomeGain. HomeGain is the place to get you started buying or selling a home, finding a realtor, and getting real estate questions answered. Go to HomeGain.com today to see what I'm talking about. All you have to do is type in your home's address, and you'll get an instant free estimate of your home's value online. It's a great way to monitor your home's value, and it's totally free. So check that out today at HomeGain.com. So what's on deck this week that can affect interest rates and move them one way or the other? Obviously, we had a lot of volatility last week with the July employment report last Friday had showed more growth than was thought, but the unemployment rate, as we discussed in the last segment, we obviously feel that that's an inaccurate report. It's not really getting better, but the stock market did rally. That caused interest rates to get a little worse last week. Not that big of a deal. However, this week, the Treasury has its quarterly refunding with the 3-year, the 10-year, and the 30-year issues totaling about $72 billion beginning Tuesday with the 3-year offering. That's about the only real data, I think, this week that traders are going to be looking at.
Initial claims on Wednesday.
The jobless claims that are going to come out. But outside of that, it shouldn't be that, big of a mover one way or the other if you're in the middle of a real estate transaction or a mortgage and you're trying to figure out what you should do. Technically, like I said, the interest rate levels are at extreme lows, so I'm very bearish as for them to be able to maintain that, because any small little thing or anything that we hear over there in Europe that's not going well could really ignite things one way or the other. So I say there's a lot more room to swing up than it is to swing down. So I definitely would say that Europe is still the elephant in the room, because we don't really know.
And as we mentioned, long term, the U.S. interest rates are going to go higher, because it's only a matter of time till the world and investors start to demand higher interest rates for the inherent risk in lending money to the United States, notwithstanding the fact that they can print up the difference, because right now the rates are so low on the 10-year Treasury,
right,
and it just doesn't make sense to loan at those rates, other than you want security. What security is there in an entity that has a $16 trillion deficit and hundreds of trillions of dollars in unfunded liabilities? Your ability to get paid back is zero.
Well, the $1 million question for most people is, okay,
that's make it a $10 million question.
A $10 million question for most people is that, okay,
inflation.
Yeah, inflation, and okay, well, obviously interest rates are low. They want to know how long they're going to stay low. And, that is the most difficult question to answer, because there's, people have to realize that the market is being artificially manipulated. This is not just a normal market. Typically, we could pick up the newspaper, look at the stock market, figure out how the stock market was going to do, and we could obviously, if the stock market was getting better, we would tell you that mortgage interest rates were probably getting worse. But we don't see that same thing anymore, and it hasn't been like that for quite some time. So
all directed from the central banks, whatever the Fed does. Right now, we should be, given what happened in the housing market, we should be in a deflationary environment. People would be deleveraging, companies would be going bankrupt, and the country's economy would be restructuring. That's not happening because they're trying to artificially spike and stimulate the economy through keeping interest rates low and then through other forms of stimulus.
Absolutely. So, moving forward, do I think that interest rates are going to spike like tremendously one way or the other? I would assume, and I'm pretty much, I think I'm pretty accurate in saying that through the election, I don't think much is going to change. I would maintain that the levels of the interest where the interest rates are at currently are probably going to be pretty steady.
They have the ability to keep them low through the tools that they're using right now.
Yeah, and so in essence, when people are looking and they're like, well, I read online that, I see that, big report tomorrow and that could sway interest rates, and I'm thinking about locking in. Well, you have to be careful because that's no longer what these traders are looking at. They're looking at the Fed. They're looking at the European Central Bank and what decisions they're going to make, which is not really what they should be doing. But
it overrides the regular economics. When you have public policy or Fed policy taking action, they can actually set the market.
Yeah, they're setting the market, and Wall Street now has market expectations of what they think the Fed should do. So when that doesn't happen, it's creating mass sell-offs or buying a ton if jobs reports gets better. I mean, it's really absurd. And what I tell people all day long is don't get caught up. The interest rates are phenomenally low. If don't try to get an extra eighth or a quarter. Don't get caught up in that because ultimately you have more to lose than you do to gain.
Absolutely, especially if you're going long term and you've got the house that you want and it makes sense to buy it. It's at the right price in the right neighborhood, and it's the right time for your life to move into that house. There's no point in trying to get an extra quarter point or an eighth of a point on your mortgage rate.
You're listening to Real Estate 360 Live. I'm your host, Ryan Sloper, joined by my guest, Louis Cammarosano, the general manager of HomeGain. I'll take that a step further as well, Louis. For people that are saying, well, Ryan, I really like to take advantage of the interest rates right now, but I can't because my credit, I've only been at my job for a year and I need at least 2 years. What I'm going to tell you is that I believe that they're going to continue to manipulate these interest rates for an extended period of time. I don't know when they're going to spike, but you should start working towards being able to, take advantage of these rates right now. Don't wait. Don't keep saying, hey, I'm going to hope that my credit gets better. Do something proactive now. Or if it's a matter of your job situation, keep saving up money for the next year so that you have a good amount of money you can put down on a down payment. There are a lot of things that you can do. Don't just let, be upset that if the interest rates go up a half or even a full point, that it's not a good opportunity for you to still buy. I believe that, interest rates below 6% no matter what is a good opportunity to buy because you're still locking in a 30-year fixed rate for at extremely low interest rates. So, while I feel like, people in conversation a lot of the time are like, I got 3.5%. So their neighbor's like, oh, I only got 3.75%. In the grand scheme of things, they're so low that whether you take advantage of a 3.5% interest rate today or a 4% interest rate a year from now or a 5% interest rate from 3 years from now, they're all great interest rates.
Ryan, it's worth really working at, if you're interested in buying a home, not talking yourself out of it, getting in touch with a professional and finding out what your options are. And if it means looking at some credit score providers who can get your credit where you need it to be to get access to these loans, because this is the main thing that's keeping people out of buying a home that want to buy a home is they can't or they think they can't get the financing, and it really is worth it to try to get that financing to take advantage of these historic low, artificially low mortgage interest rates.
877-245-2030, 877-245-2030. That's the phone number. Like I said, if you want to be put in touch to find out if we can get you qualified to buy a home, we'd be glad to do so. I would say...
And Ryan, don't you help people get qualified too? It's not just to see if you're qualified.
It's not just, you bring them in there, and if for some reason their credit scores don't meet right now, you kick them to the door. You tell them what they can do. You put them in touch with somebody that can help out their credit, or if they need to find out, okay, where do they need to be financially as far as, their job situation. There's a million different factors that come into play when you're trying to obtain a home loan. So the biggest piece of advice I can give is don't try to make the determination on your own. A lot of people will go online. They'll go to, FICO.com or freeannualcreditreport.com, and they'll pull their credit. And their credits will, not be the credit score that they've read online it needs to be. So they stop the search right there. They stop it.
They got to talk to you. if they're in the Washington, D.C. metro area.
Absolutely. And you know what, guys? If you're not in this area, call me. I'd be glad to put you in touch with a professional throughout the country that I feel like would make sure that they're doing a good job for you. So, regardless of where you're at, you can reach out to me, and I'll be glad to give you as much guidance as possible to put you in, at least let you make the informed decision with all the information necessary to do so. Want to, kind of change direction here a little bit. The Federal Housing Finance Agency has said no to the mass mortgage write-downs. There's been a lot of talk about loan modifications and whether, they're going to actually allow to write down principal balances on these mortgages. Well, lo and behold, FHFA has said no. They have basically said that, citing that there is no direct benefit to the taxpayers for them to do this program. Well, did they really think there was going to be a benefit to the taxpayers to do this?
As if the government does things, or all these agencies, for the direct benefit of the taxpayer.
Yeah, they were basically did the math, and they were like, well, if we write down $50,000 on somebody's mortgage, who's going to pay for that? We're not paying for that, so we're going to give it to the taxpayer, and they're not going to be able to make that difference over the next 20, 30 years. So there's no profit to be made from the taxpayer or for the taxpayers. They always say for the taxpayers.
Right.
At the end of the day, the taxpayers don't see anything. So, yeah, the program doesn't make sense. I could have told you that. Why did you probably create another committee to figure out if it was going to work and pay, however much that committee cost to start up, $100 million probably, to try to come up with solutions? They spin their wheels nonstop, and it's really ridiculous. I mean, you can just look at this for face value and say that it's not going to work. I don't know what took them so long to do so. So, obviously, what that means is FHFA, they're the ones that manage Fannie Mae and Freddie Mac, which both obviously have been held in federal conservatorship since late 2008. So there's been a big push from the administration to try to get them to be able to write down principal balances. That's not going to happen. So what's going to continue to be in place is the HARP 2.0 program, where if you're same lender to same lender servicer, you can pretty much go up to unlimited CLTV, meaning if your house is worth $100,000 and it's, you owe $200,000 on the loan, you can refinance. However, your loan has to be owned by Fannie or Freddie, and you have to be current on your mortgage and still have good credit scores. So there's a lot of caveats there. Best advice, just reach out to me, and we'll see if you're a good fit for the program. And if we can help you, we will. It's 877-245-2030. When we come back, we're going to jump in to should you rent your house if you can't sell it? And we'll let you know the key things there when considering this when we come back. Stay right there.